Welcome everyone to our webinar on how to maximize your tax returns. My name is Adi. I'm a product marketing manager here at Taylor Brands, and I'm super excited to be here for the second year in a row to help all of you get the tax basics you need just in time for tax season. So before we dive deep into taxes, for those of you who are new to our community, Taylor Brands is a business building platform that simplifies the business journey for business owners at every step. So from launching your business in your state to setting you up with all the tools you need to operate year-round. So whether you're just starting out or have already been in business for a while, our team is dedicated to guide you through the next steps of building your business and providing everything you need to succeed. Great. See, the numbers are still going. Okay, so as we all know, tax season is just around the corner, and filing your taxes accurately and on time is super important, especially as a business owner or a new business owner. And that is exactly why I'm very happy to introduce our guest for today. This is Elliot Gadgetdar here with me. Elliot is the VP Product and Advisory from 1-800-ACCOUNTANT, and he will soon help us understand everything you need to know about maximizing your tax returns. We're actually very happy to partner up with a company like 1-800-ACCOUNTANT because of the true value and expertise that they bring to our customers when it comes to your business taxes. So here's an overview of our session for today. We will soon begin the session, and I will hand out the mic over to Elliot. He will explain everything that we need to know as shown on your screen. And make sure to stay tuned because after the session, I will share the amazing offer we have available for all of you today, especially those of you who made it live and joined us. And don't forget to ask all of your questions in the chat. Some of you have already written, so continue writing there. We will do our best to answer the questions throughout the session, and we will also set aside time at the end for Elliot to answer your questions, so keep them coming. I want to now quickly share why Taylor Brands and 1-800-ACCOUNTANT makes the perfect team for small businesses. So as I mentioned, our goal at Taylor Brands is to provide all the tools you need, whether it's making your business official, to building your online presence and staying on top of different annual requirements, such as filing your taxes. That's where our partnership with 1-800 comes in. Their team of tax experts allows us to offer seamless access to tax services, personalized advice, and ongoing support. Together, we make managing your business and taxes easier so you can focus on what truly matters, which is growing your business. And now, the moment we've all been waiting for, Elliot, I'm going to hand it over to you.
Sounds good. Well, thank you for having me here again.
Thank you.
So for everyone, to give you a little background information, how we're going to present this is we're going to use a use case. We're going to use a hypothetical business named Mel's Soap and Wax. I'm going to walk you through the step-by-step of how we assess the business to look at tax strategies and so forth. Now, keep in mind, every business is different. So realistically, when we do planning, we want to know what the goals and underlying needs of our clients are, because the planning strategies we have for a business that is, say, for example, $1 million in revenue is not the same as someone who is, say, for example, $20,000 in revenue. So when we plan throughout the client's, their taxpayer situation throughout the years. You can look at it that way. So for this hypothetical situation, we're going to look at a few key items. And this isn't all that we considered when we're doing planning. This is a lighter version. You can look at it this way for planning strategies that apply to most businesses. So when we bring on a client for tax services, we do an assessment. We look at it and say, okay, what is your business? Where are you at with the business right now? Are you a first-year business? What's your business structure right now? Are you in corporation? You're an LLC? Or maybe you're just doing it under your personal name? We look at those situations as well to gather information along even with states, because even your state income tax levels will have an impact on the planning that we're going to do for you as well. We factor in other items like costs that you already have incurred, like your startup costs, how much money you've invested into your business already, what your profit looks like, your revenue, even down to if you're going to hire employees, and what your marital situation may be if you're going to file jointly with a spouse, and your other sources of income. Now, it may sound weird, we're saying, hey, why are we asking about personal income, like your household income, like a W-2 versus your business profits? Well, when we go through it, you'll see that your business and your personal side are very intertwined. So to give you like a concept, your business, typically for most business owners, there was called a flow-through entity. Now, how a flow-through entity works is, this may sound weird. Your business itself doesn't pay the taxes in most cases. The rare exception is if you're a C corporation, but the business doesn't pay the taxes. What happens is the profits that your business makes, we take your profit from your business, we place it on your personal return to say, hey, for example, John owns this carpentry business. John's carpentry business is going to flow over onto John's personal name, and then John's personal side is going to pay the taxes owed for the profits in that business. That also means if you have a business partner, let's say, for example, it's John and David, they form a partnership LLC. We calculate out what John's share of the business profits are, what David's portion of business profits are. Then we put it on their personal return, and the taxes may vary widely, depending on your situation. Meaning, for example, if John is making more than David and is in a higher tax bracket, if both of them made $50,000 in their business, their tax situation may actually end up being different because, again, your business is not paying a tax. We are calculating it out. We file a business return for you, but the return is informational, and that's going to go onto your personal return. You pay your taxes on your personal return that is due. You can look at it that way. So that's the concept of flow-through entity is the profits. If you are a sole proprietorship, meaning you're starting out yourself, only owner of the business. If you're an S corporation, I see we in the audience, we have a couple of S corporations. If you're a partnership, you're a flow-through entity. All of those profits that you make from your business is eventually going to trickle over to you on your personal side, and you're going to pay taxes on your personal side. Only exception is going to be a C corporation, which applies to a smaller portion of clients, but it's something else we tend to plan here as well. So you can look at it that way. So when we're looking at your situation, we look at it holistically to say, what are you looking to do overall in the next couple of years? Where are you at right now, not just in your business, but also on your personal side, because it's going to impact how we're going to plan for you for your taxes. Now, to give you an idea, one thing you can do if you have an LLC set up is you can do what's called an entity classification election. Now, I see, for example, Harry, great to have you. It looks like you're an S Corporation LLC. You may be familiar with this, but I'll give you a little breakdown. So an S Corporation, when you first form your business, you're going to be generally one of two types. If you have an LLC, you're going to be what's called a single member LLC. Single member just means you're the only owner of the business. Look at it that way. So you're the only owner of the business. By default, when you first open that business, you're a single member LLC. If you have more than one owner, 2 owners, 3 owners, 4 owners, whatever it may be, by default, you're what's considered a partnership LLC. You'll clear it up, at least for tax purposes. So again, when you first open up your business, 1 or 2 paths you're going to follow. Single member LLC, you're the only business owner. Partnership, that you're going to be more than one owner. You can look at it that way. Now, that is your default state of how the IRS is going to tax you. However, you have options here. We have what's called an entity classification election, in which we can change the way you are taxed. Now, that also means all the corporate paperwork you've already filed, your LLC paperwork, everything you've already done, it remains the same. Nothing is going to change. What we do is we prepare a paperwork, but it's not a corporate paperwork we prepare. It's an IRS paperwork. You can look at it that way. That we send out to the IRS to change your tax structure. Now, the question is, why would I want to change my tax structure? What is this S corporation? What do you mean? I'm going to give you examples of it. But first, I just want you to be aware of when you first start off, you're a single member LLC or a partnership. If you want to change your election, you can do so. Now, you can do what's called an S corporation election. That's typically recommended by the IRS within 75 days of your business being formed. and I'm going to explain why you may or may not want to do it. In most cases, for the vast majority of clients, it is beneficial to them. I'm going to walk you through a situation so you have an understanding of it. Now, let's start with taxes. I mentioned before, you have your business profits going to go to your personal return. You're going to pay the taxes from your business, the profits on your personal return. Question is, what taxes are you going to pay? Now, the taxes you're going to pay is, you're going to pay your federal income tax. That's the IRS. That's going to be, if you had a W-2 job, for example, your federal income taxes that show up in your regular W-2, similar concept if you're a business owner. You're going to pay federal income taxes. If you live in a state that has a state tax, see plenty of California people, New York people, New Jersey people, you have taxes as well that you're going to pay on the state side. Localities, if you have a locality, I think I saw a New York City person in the audience, you're going to pay your city taxes, your locality taxes as well. So federal taxes, that's the IRS. State and local, if you're whatever state you're located in, whatever locality you're located in. There's a third tax now. Now that third tax is FICA. Now it's known as a different name. If you had a W-2 job, it's Social Security and Medicare. The Social Security and Medicare. If you're a business owner, you're going to pay Social Security and Medicare as well. So the three taxes you're going to pay is your federal taxes, to the IRS, your state taxes, and then that Social Security and Medicare called FICA. Now, if you're a business owner, you're self-employed, you pay 15.3% of your profit. So after all your expenses, calculate it out, your profits, what do you take home? Profits, you're going to pay 15.3% of that. So I'm going to give you one example. You have a client who did not make an entity classification election. This means they're running under personal name, or they're a single member LLC, or they could be a partnership as well. On $20,000, they're going to pay that self-employment tax, that FICA, your Social Security and Medicare, of 15.3%. On $20,000 times 15.3%, that means you're going to pay roughly $3,000 in that self-employment tax, not even including that federal taxes or your state taxes. That's the first way. That's your default state, is you're going to pay the 15.3% on your Social Security and Medicare. Now, the other portion is, if I made a selection, let's say I formed an LLC, I decided I'm going to become an S corporation, there's a different way your tax is going to be calculated now. Now, your federal taxes, your state and local doesn't change. What we're going to change with this election is we're going to change your FICA taxes. That's Social Security and Medicare. It may sound weird. Now, you can be the only owner of your business. For example, Kenneth, you are a single owner. You can be the only owner of your business, but you could actually employ yourself in your business. So you'll be both the employer and the employee. With an S corporation, how it works is you pay yourself a salary, even though you're the only owner of the business. You're going to pay yourself a salary. So your business is going to pay you for the most part, and the amounts that you pay is going to be subject to Social Security and Medicare. Your business is going to run payroll. It's going to issue you a W-2. You pay Social Security and Medicare taxes on the amounts the business paid you. However, the difference that the business did not pay you, so let me give you an example. You made $20,000. I paid myself $10,000. That $10,000 you paid out of that $20,000 is going to be subject to that Social Security and Medicare tax. You got another $10,000 remaining. That $10,000 remaining is not subject to Social Security and Medicare. You're still going to pay your federal taxes and your state taxes on it, but no Social Security and Medicare applies to this. So in this case, the example would be I earned $20,000. I paid half it myself. I paid myself what's called a reasonable salary. I paid half it myself. I got $10,000 remaining. Your saving is $10,000 times 15.3%, the portion that is not subject to Social Security and Medicare. In this example, just by changing your structure, you're going to save $1,500. And this actually continues throughout. You can say, for example, 2, 3, 4, 5 years, but this structure will continue throughout the actual life cycle of your business. So it's a great way to increase your savings or your tax savings that way by looking at types of structures like this. You can look at it this way. So that's the first thing that we normally recommend is we assess your situation and say, what is the best type of entity for you? Is it an S corporation or maybe it's not? You can switch this. Again, IRS recommends it within 75 days of the entity being formed, but there are parameters in which I see I have a couple people asking about it. We can also do late elections to potentially switch you over later on as well. So say, hey, IRS, I didn't know about this election before. Can you accept this now for the most part? And generally, they'll accept it as well. Call it late election relief. You can look at it that way. So, question from the audience, I'm just going to answer because I think it's important for everyone. It's coming from George. It's, what happens if you lose money the first year, you have no profits? Now, the IRS regulation for this realistically says you have to pay yourself a salary that is reasonable for your business for someone to do a reasonable, similar structure, similar business that you're going to do. Meaning, let's say, for example, if I'm a janitor, you look at the salary for a janitor. If I'm a CEO, you look at the salary of a CEO for a business, and you say, okay, great, here's what the typical reasonable compensation, what someone else in this typical place would pay if I had to do the same exact job. So theoretically, if your business is losing money, you could make a defense that, hey, the business is just starting up for the most part. I haven't paid myself as yet, only because the business is straight up fresh. You could look at it that way. Just to give you a little background on this. Now, this is just one area that we can do so. A question from Daniel as well is asking, if I made the election now, I want to change it later. Is it complicated? Answer is to remove it. It's not complicated. To add it back after you remove it becomes complicated. So we like to assess this for our clients. The reason why is an S corporation election or a C corporation as well. It's a different election as well. We can make the election for you. However, if you change your mind later on and say, hey, I don't want this election for whatever reason, it's easy to remove it. But if you want to apply it later on, like say, for example, I became an S corporation, I removed it, and I want to bring back that S corporation, it becomes tricky. The IRS is a 5-year lockout period, meaning they're going to make you wait 5 years before you could apply for it again. And it's up to their discretion to approve it. So it's not a decision to make lightly, but it's one that we like to consider our clients to sit down with them and say, hey, what's your goals for the next couple of years? Let's look at it to see what's actually most beneficial for you. You can look at it that way. This is just one area that we tend to plan for. I'm going to cover 4 major areas that applies to most small business owners. But again, these are not every strategy that's available to a business owner, but these are the ones that typically come up that you should definitely be aware of. We're going to talk about your startup costs. We're going to talk about vehicle deductions, home office deductions, and my favorite was called 199 Cap A deduction. It's a deduction exclusively for small business owners. I'm going to discuss that with you. I'm going to walk you through hypothetical situations as well, because every calculation is different. It depends on your situation. So to dive in, I'm going to start off with a vehicle deduction. This is travel. You're traveling primarily for business, meaning I'm going to the client site and so forth. Now, this is a combination. I'm going to talk about the vehicle deduction and the home office deduction on the same screen because they both have an interchanging effect. So I'm going to start off with what's considered deductible for your vehicle. Your vehicle deduction, for example, your vehicle deduction applies to travel that you primarily do for business. What's primarily for business? You have a business case. It doesn't mean you actually made money off of it. You could be prospecting. I went to potential clients. I went to the store to buy items for my business, whatever it may be. I went from site A to site B between clients. However, there is one type of travel that is not applied here that you cannot take with an exception, that home office exception. So that the exception is you cannot deduct your commuting, meaning if I went from my home to my client site, went from the client site back to my home, typically that wouldn't count because it would be considered commuting expenses. However, there is an exception to this rule because most small business owners are saying, I travel from my home to the client site. It is commuting. Is there a way to get this deduction? The answer is yes. The answer is if you have a home office, and I'll discuss what a home office is in a bit, but if you have a home office, travels from your home office to the client site and back is no longer considered commuting. It is considered a legitimate business expense. You take the expense off as well. You can look at it that way. So they're both kind of intertwined. Now, both the vehicle and the home office, there are 2 different ways we can calculate this. Now, for my clients, I set them down. I calculate it both ways. I say, hey, John, I know you don't want to keep track of paperwork. keep track of it anyways. Give me the information at the end of the year. I'm going to calculate it both ways. I'm going to present what is best for you. You can let me know what you want to do. The first way for vehicle deduction is you can take expenses in what's called a standard mileage rate or standard deduction, in which in this case, the standard mileage rate is 67 cents. What it means is for every mile that you drive, you're going to get a 67-cent deduction that you drive for business purposes. I drove 1,000 miles, multiply by 67 cents. If I drove 300 miles a week, every single week, I drove 15,600 miles in a year, I'm going to get a $10,400 deduction for all of those travels that I have done. That's your deduction. It's not your, tax return amount, but you can use that deduction to offset your income. So if I made $10,400 in revenue, I had $10,400 in vehicle deduction, I have zero income. Zero amount is going to be taxable for me. You can look at it that way. Now, that's the first way is we calculate your amount of miles driven. These amount of miles driven, again, is you drove for business purposes, you calculate it out. However, under this method, it's either or. I could take the standard mileage rate. I cannot do both, meaning I cannot take the standard mileage rate and I cannot take actual expenses. It's one or the other. The standard mileage rate is meant to simplify your paperwork to say, hey, I drove this amount of miles, give me this deduction. But that means you cannot take your fuel, your gas, all those other expenses, your repairs. You can't take it as an expense. That's the first way, though, is to simplify it, how many miles I drove. The other way you can do is actual expenses. Now, actual expenses work differently. Actual expenses is I'm not taking the miles, that's 67 cents per mile. I'm taking the actual expenses. Now, you prorate this out. You can use your personal vehicle for business use. Most people do. I do as well. So to give you a breakdown, how you calculate the actual expenses is you prorate it. You look at the amount of miles you drove for business. You check your odometer in your car and say, the total odometer says I had 20,000 miles. I knew I drove 10,000 miles for business. That's 50% of your vehicle use is now business expense. You could take 50% of all the costs for that vehicle. So that could be your fuel, your maintenance, your gas, your oil changes, your tires, repairs, everything else. You could look at it that way. And also the purchase price of that vehicle or your cost basis. So let's say, for example, if I bought a $30,000 vehicle for business purposes, or even my personal vehicle, I bought a $30,000 vehicle for personal use, but I'm using it for business as well. I use it half of the time. The IRS is going to say you could take that $30,000 vehicle. If you use it half for business, well, $15,000 is your cost of that business. You can take that over time to say the IRS pretty much says your vehicle is not going to last forever. Divided by 5 years. Every year you get 1/5 of that vehicle expense, the purchase price, as a deduction. So if I bought it for $30,000, use it half for business, that gives me $15,000. I'm going to divide it by 5 years. Every single year, just for owning that vehicle, you're going to take a $3,000 deduction for up to 5 years. As a business deduction, it's called depreciation. That's another method we can calculate it. And there's ways to speed this up. There's what's called bonus depreciation. There's even calculations depending on the weight of your vehicle to speed up the vehicle if your vehicle is heavier, meaning if it's a vehicle over 3,000 pounds, there are methods to calculate it to say, instead of taking this over 5 years, maybe we could take it all up front. When we calculate this out, we look at your situation and say, what is most beneficial for you? And then we weigh the option for you to say, hey, for example, you have this option where you get X amount of deductions, or you have Y. Which one do you want to take? Here's the reason why. Let's look at a vehicle deduction. If I took the vehicle cost up front and I expense it all up front, that means next year I'm going to have less depreciation. I'm going to have less to expense. Just because I already expensed the vehicle in the first year, I can't expense it in the second. I could take the expenses that are used for repairs and so forth, but I can't expense the entire vehicle anymore. In that case, a standard mileage rate may have been better for you in the long term. So we look at it to say, not just what's most beneficial for you right now, but what it is over a number of years. You can look at it that way. That is your vehicle deduction. You can look at it that way. The other option is, in tandem with this, is your home office deduction, in which your home office deduction follow a very similar method. The home office deduction, you have a standard rate or a simplified option in which we look at the space that you use in that home. And we say, how many square feet are you using for business purposes exclusively? And we give you $5 deduction per square foot, or the IRS does, up to 300 square feet. So that means if you have a space in your home that's using exclusively for business, you say my home office is 100 square feet, I take the 100 square feet, multiply by $500 deduction. You can look at it that way. You can do this up to 300 square feet, but that's simplified option. Simplified option is very similar to that standard mileage. They give you a flat rate based on your square footage. The one caveat with this home office deduction, it's got to be exclusively used for business. So by exclusively used for business, it means it has to be a place in your home that you're actually using for business purposes. It cannot be a mixed use. A mixed use may be, for example, if I use my desk for personal entertainment and I use it for business, it has to be a space which you're using exclusively for business. You can look at it that way. But it doesn't necessarily have to be a room. It could just be a portion of your room that you taped off and said, I'm going to use this for business purposes. You can do that as well. That's a simplified option where you take $5 a square foot. The other option is you prorate out your costs, similar to like a vehicle. If, say, for example, I have a 1,000 square foot house, 100 square feet is my home office. I could say 10% of my house is a home office. I take 10% of my expenses, my rent, my mortgage interest, property taxes, utilities, whatever you may have, and so forth, your normal upkeep of your house. Utilities could be included in anything under the sun. Well, not anything under the sun, but you get the idea. It could be electricity, gas, and so forth. All of this applies, and you take a calculated amount at the end of the year when we do your tax return. You can look at it that way. So we calculate it out both ways, similar to how we calculate out the vehicle deduction. We find out what works best for you and under both methods. And that's where we discuss your options and say, hey, John, we're going to apply that home office deduction because it's more beneficial for you under that regular method. And then the vehicle deduction, maybe we apply the standard mileage rate because it may give you a higher deduction. So we calculate out both ways for you, and we give you the best one that's most advantageous to you. You can look at it that way. So that's a quick breakdown of those two major deductions. So the other question is, I've been talking a lot about profits here. The question is, what about loss? What happens if I just start off my business? I've invested into my business. The business hasn't made a profit yet because I just started the business. I started it last month or a few days ago. It takes a little while to build up my clientele and so forth. Losses actually benefit you as a business owner as well. Now, how it works is, remember I mentioned before, your business and personal are kind of combined together. You're going to pay one tax on your personal side based on your profits of your business. It's going to flow over to your personal. What if I have a reverse situation? I just formed a business. I'm running a loss on the business only because I just started up. I'm still trying to get my clients and so forth. I'm still trying to refine my product and service, whatever it may be. The losses give you an actual tax benefit. How it works is we look at your personal side to look at any source of income that you have that is taxable. Now, what it can be is most people, it's a W-2 job. I have a W-2 job. I'm a business owner as well. I start up my business. And my business, for example, let's say made a $10,000 loss or whatever it may be, you can use that loss to offset your other income sources like your W-2. May sound weird, but I'm going to give you an example of this. Let's say I made $25,000 on my W-2 job. I had a $10,000 loss on my business. So what I made at the end of the year is I made $15,000. $25,000 W-2. I had a $10,000 loss in my business. I made $15,000 at the end of the year. Well, your W-2 job is withholding taxes. It's taking taxes out of your paycheck every pay period. They're taking out taxes from it. The amount of taxes that they're taking out, it's assuming at the end of the year, you're going to make $25,000. So it's calculating out your tax bracket or your taxes owed on $25,000 of income. Your income actually is not $25,000 at the end of the year. When I take my business losses, it's $15,000. That means that W-2 job you've had has overwithheld. It's been holding out taxes at a $25,000, assuming you're making $25,000, you're making $15,000. That business loss is going to help offset some of your W-2 income. And if you're withholding correctly, you're likely going to see a refund, a refund because of that as well. You look at it that way. It's not going to be the full $10,000. It's going to be $10,000 times your tax bracket rate, whatever your tax bracket is. But you can look at it as it's a great way for incentivized business owners to say you are taking a risk. You are essentially going out there trying to build something from scratch. you get a benefit out of it. If you are running losses, it'll offset your other sources of income. You can look at it that way. Now, that's just an example of how your losses can offset your income. There are other items you want to consider with this. You want to consider deadlines. So your deadlines, for example, most taxpayers file April 15th. Your personal return is due April 15th. If you are a single member LLC, it's also due April 15th with your personal return. However, if you are a partnership or an S corporation, your deadline is a little bit different. Now, I mentioned before, a partnership just means you have more than one owner. I opened my business, my buddy, my partnership return. I'm a partnership now. I could be an LLC, but I'm a partnership LLC for tax purposes. That is due March 15th. Now, here's the reason why. We need to know the profits, so the IRS needs to know of what the share is. Meaning, let's say John and David went into business together, and John's share of the profits is 50%, David's share of the profits is 50%. I mentioned it's going to go on your personal return later on. So what the IRS wants is they want a filing if you're a partnership or an S corporation a month ahead of time of your personal. So by March 15th, you got to file that partnership return. And that is just, or S corporation return, and that's just going to indicate what your share of the profits are. The issue is called a K1 with that return. We take that K1, put it on your personal return, and you pay your taxes on that amount. Whether you owe or if you ran a loss, we use that loss to offset your other sources of income. But again, one important thing is if you're a partnership or a S corporation, you're going to have a filing before your personal. It's going to be due March 15th. You can look at it that way. I mentioned that entity classification election that's typically due within 75 days of your business being formed. If you're past 75 days of your business being formed, it's not the end of the world. We potentially do a late filing election, depending, generally the late filing election, it says, hey, IRS, I didn't know about this S corporation before. Can you offer forgiveness? You can look at it that way. It's called a late election relief. So that's for the election as well. And the other thing you should understand is estimated taxes. Now, the reason why I like to explain estimated taxes is I like to compare it to a W-2. With a W-2 job, and I'm working for someone else, taxes are coming out that paycheck. Every pay period, whether you get paid every 14 days, every 15 days, they take taxes out your paycheck. They're withholding taxes for you automatically. If you're a business owner, no one's taking out taxes for you ahead of time. Now, I see this a lot with small business owners is their business thrives. They do not anticipate making as much as they were expecting. And then at the end of the year, a windfall happens. Their business is very profitable. What happens now is the IRS wants their cut. So what I like to do is we assess this quarterly. The IRS actually wants their money ahead of time. When you have a W-2 job, they take out the taxes, your paycheck every 2 weeks. As a business owner, no one's taking out taxes from your paycheck every 2 weeks. So what they want you to do is every quarter, we calculate out an amount to say, hey, this quarter, your business made $30,000. This quarter, it made $5,000. We calculate out the profits and how much taxes is going to be owed on that quarter. So we say January, February, March. Let's add it up to see how much profit you made in January, February, March. If you're profitable, we calculate a quarterly estimated tax amount. And we said, here you go. You made $20,000. On that $20,000, you may owe $5,000 in taxes. Remit this payment to the IRS ahead of time. So every quarter, we calculate an amount and tell you to remit it to the IRS ahead of time. The reason why is when we go to file your tax return, if you do not remit those estimated payments, there are what's called safe harbor thresholds based on how much you owe. If you owe $100, the IRS is not going to worry about you making estimated payments. But if you owe $10,000, $20,000, whatever it may be, they may charge you interest and penalties for not making these estimated payments ahead of time. So that's why we like to meet with our clients every quarter. Let's calculate out the numbers, see what it looks like, and say, here you go. Here's your underlying situation. Let's see if we missed any deductions we can for this quarter, factor them in, and then we calculate out your estimated payment as well. You could look at it that way. And the other portion is loan agreements. You can do loan agreements between you and your business. There's one of two ways you can do this. You can do an actual loan, meaning it may sound weird. You could be the only owner of the business, but you can do a loan between you and the business for the most part. That's the first way. Or if you had expenses prior, like say, for example, you had expenses before your LLC was formed, you could toss it into a loan, or you could do it as what's called a capital contribution. We discuss your options with you for the most part. But the big takeaway from this realistically is all those expenses you had, all those startup expenses, everything else, we want to make sure it's accounted for in some way. That way you're still fully entitled to the deductions and benefits you should have. You can look at it that way. So that's a quick breakdown of some deadlines you should be aware of. Quarterly estimated taxes happen every quarter. So we calculate it out to see every single quarter what it looks like and so forth. You can look at it that way. So these are just some of the items that we've covered throughout. We've talked about the entity classification election. We talked about some deductions and so forth. Again, it depends on your situation. We like to customize it to say, let's get to know you as a person. What are your goals? What are your opportunities as a business owner? That way we could tailor a strategy that works best for you. Not just the one that gives you the best number in pen and paper. We like to say, look, let's look at it not just on the first year deductions. We want to look at it to know what deductions can carry over to the second year, the third year, the fourth year, the fifth year, and so forth for you as well. So we sit down with you and discuss your options and so forth. You can look at it that way.
Thank you so much, Elliot. That was super interesting. And even learning this the second time around, I definitely learned a lot. And I'm sure that everyone else here also learned all the insights and gained all the value that they needed just in time for tax season. Of course, feel free to continue asking your questions. We will still have some time to answer questions. But now it's the moment we've all been waiting for. I'm happy to show you our offer for today. For those of you who joined us, we're offering 25% off of our tax filing services. This includes both business and personal annual tax preparation and filing. Just so you know, one of the best parts of getting the tax services is that your business expenses can actually be marked, including the tax filing. You can count them as your business expenses for this upcoming year and for this tax season. Is that correct, Elliot? Great.
That is correct.
So I will now, the offer is live. You should now be able to see it in your screens. And if you're unable to click it for some reason, don't worry, we will be sending you an email with the recording of the webinar, and it will include the offer as well. You should be able to access it now, but just in case, we will also be emailing it directly to you. And I would now like to open the floor for questions. And by the way, everyone, if you have any questions later on or something comes up, you can always contact our support team or give us a call. You will also see the details in the email of how to get in touch with us. So no worries if your questions don't come up right now. Let's see which questions we have.
Let me tackle a couple questions. I see some interesting ones in the audience.
Some of them have already been answered, so I'm just trying to see where we left off. Go ahead.
Sure. So, Marty, you had a question from driving from your studio each day. The answer is yes, it'll count if you also have a home office as well. So your home office to studio travels will count as well. If you didn't have a home office but had a studio, it wouldn't count. The travels be considered commuter miles. You can look at it that way. And I see a great question from George is if you had a loss in your business, you don't pay self-employment taxes. That is correct. So you could think of it as self-employment taxes is based on the profitability of the business. So if at the end of the day, you had more expenses than you had in revenue, you ran at a loss, there is no self-employment taxes that's going to be imposed on yourself, including income taxes. In fact, it actually do the reverse. It won't cause a tax due. It may be able to use your offsets from your other source of income to potentially get a refund. You can look at it that way. I see some other questions regarding deductions of flights for other business members or potential clients. The answer is yes. Now, for deductions from Daniel's question, to give you like a heads up, the IRS pretty much allows you to deduct what they considered reasonable and ordinary and necessary. The key word here is ordinary and necessary for deductions. It may sound very weird, but that's actually the IRS term. It's ordinary and necessary. So it varies based on person to person. Ordinary and necessary is if you are in a similar business with similar levels of revenue, similar services that you are performing, would a normal business have that same level of items? Like, would they have the same travel expenses? Would they have the same type of expenditures? Now, it may sound weird. Ours is very vague on it. Literally, their actual term is ordinary and necessary. So to give you an idea, is business travel something that normally happens between potential clients? Absolutely. But for example, if I went out and tried to buy, say, a $500,000 car for my new startup business, the IRS may question it. They may say it's not ordinary and necessary. But I've made the opposite. To give you like a background by myself, I'm a CPA. I've done audit representation in person for people as well. I've defended it to the IRS to say, hey, this client has purchased a $200,000 vehicle. Should be deductible. It is fully ordinary necessary for their situation. Because at the time, I'll give you an example, it was a realtor showing high-end homes. They're showing $15, $20 million apartments in New York City. If I'm saying they're spending $200,000 on a vehicle because their clientele is expecting a level of comfort when they show those properties, that I would say is the actual ordinary necessary expense. Versus if I just started up my business, trying to deduct $200,000 on a vehicle may not apply as much, just because the IRS may say it's not reasonable or ordinary necessary for your situation. It's a gray area. There's no definitive area or definitive line for it. So certain deductions are black and white, but for your travel side, I would make a legitimate argument for that to say, yes, I'm traveling to go see a potential client, or I brought a contractor or a potential employee with me as well on my travels as well. You can look at it that way. If you're doing it for mixed use, if the primary goal is you're using it primarily for business, meaning, for example, if you went on a 5-day trip, you're meeting with clients for 4 days, for example, your flight will be considered deductible, to give you an idea. If you want to spend 1 day on the beach, it's okay. But the purpose of it has to be a primary business use when you're looking at those travels for the most parts. And primary just means more than half of your time is going to be spent either prospecting clients, fulfilling the work, and so forth. You can look at it that way. A question from Rita regarding the business losses applying to the W-2. Are there conditions for this type of transaction? Yes, there's a couple, but for most people, it doesn't really apply, but I'll give you the breakdown as well. First, you have to actually have other sources of income. Like, for example, let's say I just opened my business, but I didn't have other sources of income and the business ran at a loss. I can only use losses to offset income, meaning if I didn't have a W-2 job, I didn't have stocks or anything like that or gains, I only had a business loss that year, I can't use that loss because I have no offsetting income for it. However, you wouldn't lose that loss. Like, say, for example, let's say in year 1, you had no W-2 income, you had a $10,000 loss. Well, I have nothing to offset. I have no W-2 income. But in year 2, when I got a W-2 income, the loss I had from year 1 is called a carryover. The loss I had from year 1, that $10,000 loss, I can use it in year 2 to offset the income in year 2. Even though the loss was from year 1, I can use it into year 2 only because I could offset it last year. So it gets carried forward into the next year's. You could look at it that way. Depends on your situation, but that's the most common one that tends to be a little bit iffy, or I don't say iffy, but it may not apply this year, but it'll apply into the future years. You could look at it that way. And for Marty, a question regarding actual person to put together the returns on the phone or a video. Yeah, we do phone calls. In fact, that's actually what we recommend. We'd like to actually talk to you about it, sit down, discuss the situation, because as we're preparing your return, situations may come up where we'll say, look, Marty, we can take the deductions one of two ways. How do you want us to proceed? We want to give you your options available to you as well. You can look at it that way. And from Gina, the process for changing an LLC to an S corporation. Now, to backtrack a little bit, all your LLC paperwork is going to remain the same. Everything you've already done, all your filings remains the same. For S corporation, that's just a tax treatment, not a corporate treatment, a tax treatment. So we just tell the IRS, hey, here's my LLC, Gina's LLC. I want to be taxed differently. You can do so. We file what's called a Form 2553 to the IRS to say, here's the LLC in question, the formation state, the date, the owner's information. The owner signs off a piece of paperwork and they mail it to the IRS or fax it. And that's how we apply that that S corporation election. But again, your LLC paperwork remained the same. We're just giving an election to the IRS to say, I want to tax my LLC just a little bit differently for the most part. And Chris, a question regarding your charitable donations on the name of your LLC, if you could write it off. It's actually going to give you the same treatment as if you donate on your personal side, if you're the only owner of that LLC. So if, say, for example, let's say my business decided to donate $100 to a cause, a charity, that $100 is going to get reported on your business return to say I gave $100 to charity. It's going to show up in what's called a K1. Again, that's on your business return. So it's going to say Chris gave $100 under his LLC for X, Y, and Z cause of charity. When you go to do your personal return, that $100 is going to flow over to your personal side, and it'll allocate the $100 donation under Chris's name, your personal return. You can look at it that way. So it gets a very similar treatment to your personal. The only thing that really changes is how it's going to get reported. It's going to go from business to your personal side, but the tax amount, your benefit amounts, and everything else is going to remain the same, as though you've deducted it on your contributed to your personal side, I should say. And for Jalissa, I think hopefully I pronounced it right. Apologies if I haven't. I think you had a question regarding Social Security disability, and you took loss in your business. So if you took loss in your business, you're going to offset taxable income. If your Social Security disability, for example, if it's structured in a way in which it is not taxable, if you're taking a loss in your business and it's not taxable, you wouldn't necessarily get a tax benefit out of it because you could use your losses to offset income in which you're paying taxes on. If your Social Security disability is tax-free, for example, you wouldn't be paying taxes on that disability amount, so the losses wouldn't apply. But again, you're not going to lose that deduction, meaning if you took a loss in your business, it's going to keep carrying forward. If you ever, in the future, ever have taxable income, it's going to use that to offset it. And it could roll over more than 1 year. I just gave one example from year 1 to year 2, but I've seen clients roll that from year 1 to year 3, 4, 5, especially in businesses that take a little while to get off the ground. It could be they're very R&D heavy, for example, and so forth, but it's going to take them a number of years to build up. So you're not going to lose the losses, just going to get carried forward. A question for Ivo is, can you use your memberships at tennis club as a tax deduction? The answer is potentially. It's a little bit of a aggressive position, but it depends on your situation. You could potentially make the argument that, yes, I'm using my membership as a networking for the most part, but the IRS tends to question these items. They'll say, hey, is your primary benefit the actual tennis club, or is your primary benefit the networking opportunities that have been applied? You can look at it that way. We could discuss your options, to figure it out on the way. You can look at it that way. Question for Yasir. This is one in which we'd want to discuss with you in more detail. This is regarding that section 179. This is to fully depreciate or deduct your vehicle in the first year. So to give you a breakdown, your business will normally depreciate that vehicle over 5 years. So whatever your price of your vehicle is or your cost basis, every year you get a 1/5 deduction. Now, there's 2 different ways that we can calculate this out. But again, we would want to speak with you in person and discuss your options. The IRS scrutinizes it very well, scrutinizes it quite a bit. However, the way I like to say it is keep everything well documented. If you have it documented, you can make a business case, you take that deduction. You can look at it that way. However, there's 2 ways you can calculate it. You have a bonus depreciation method, and then you have what's called a section 179 method. So there's 2 separate methods that we can potentially calculate to allow you to write off that vehicle the full amount within the first year. But we'd like to discuss it because there are options for qualification. The biggest one you tend to hear a lot from social media and everything else is a 6,000 pound rule. It is, if your vehicle is over 6,000 pounds, you're not subject to depreciation limits, in which it means you may be able to fully write off that vehicle all at once. But again, we would like to discuss your options with you to see, what options are available for you and so forth. And a question from Jennifer is, your LLC was formed the end of 2023. You haven't seen patients until 2024, and you didn't file last year. So here's the breakdown. If you were not operational, now operational means, are you able to perform services, not necessarily if you performed it. So the question is, in December 2023, can you see patients? If the answer is no, I'm still trying to get everything in order. I'm still trying to figure out, how to keep track of all of my clients. I'm trying to figure out the location where I'm going to see these clients and so forth. You're not considered operational as yet. All the expenses you had in 2023 will carry over into 2024. You'll file it all in 2024 with your 2024 return. However, flip side applies. If you're operational, you're able to perform the services, you likely should be filing a tax return in 2023. It's a gray area. It depends. The question becomes, are you operational or not? If you're not operational, we carry it over into 2024 for you. File it with 2024. Your expenses from 2023, we'll file it the year become operational in 2024. One caveat is, two caveats, two areas in which they have to file. S corporations and C corporations, they got to file regardless. So if you are just an LLC, you just started off, you're the only owner, or you're a partnership LLC, it's okay on the federal side. You will not have a filing if you are not operational yet. You'll file it in 2024. However, you may have a state filing. Depending on your state, you can look at it that way. But the IRS side, from federal side, no filing. Again, if you're not operational, you can look at it that way. Question from Shelly is, how many years can you take a loss? You could technically take a loss indefinitely. There is no set rule for it, but there is what's called a safe harbor threshold, in which the safe harbor threshold is the IRS will look at your last 5 years, and 3 years out of the 5, consecutive years out of the 5, if you had a loss, they don't question that loss to say, hey, this business realistically was called a hobby, meaning your goal of a business is to potentially make a profit. If your primary goal is to make a profit, you're allowed those losses. If your primary goal of the business is not to make a profit, they may consider it a hobby, in which case they may disallow your losses. But there is no limit. The safe harbor threshold, you can think of it as the rule of thumb before the IRS starts looking at it, is they look at the last 5 years, look at 3 out of 5 years. However, again, there's no limitations for it. I have clients before who took 6-7 years of losses, then shot up in multiple years because they took multiple years to build out a client base. That's also understandable. So if it comes as a question, it's the question to say, hey, IRS, I actually tried to be profitable. I tried to do this as a for-profit venture. I went and looked for clientele for X, Y, and Z, and here's my proof of it and so forth. You can look at it that way. And Stephanie, you recently bought a car. Your business with your own money. Can you write that off? The answer is yes. If you're using it for business use, similar concept, you would apply. We'll calculate out your percentage just using for business versus your percentage used for personal. But it's how most businesses tend to start. It starts with a person using their personal vehicle. Of course, you're entitled to that deduction. You can look at it that way. And same question from Dawn. You had no revenue coming in, but you had expenses. Can you use those expenses? Yes, if you're operational, meaning you don't have to have revenue to be operational. It's just you got to be able to perform the services. So the example I like to give people is a chef or a restaurant owner. If I'm a traveling chef, I am operational on day one. You give me a pot and pan and tell me to go somewhere to cook, I'm operational on day one. If I'm a restaurant owner and I don't have my restaurant as yet, I'm still looking for leases. I'm technically not operational now. I'm going to carry that over into the next years because, again, I'm a restaurant owner without my lease. I haven't built up my property as yet, so I can't see customers or clients as yet. You're not considered operational. You can look at it that way. So it depends on your situation, Don. But you can look at it as if you could perform the services, regardless if you had no income or revenue, you're entitled to take your business deduction for it. You can look at it that way.
Elliot, we have time for one more question.
Sure. I'll answer. To be fair, I answered in a little bit of chronological order. I'll go with Jennifer's question regarding your credit card statements as proof for gas and dining, no receipts. So I like to tell my clients, take the deduction anyways, but please keep track of it. Meaning what I tell them, if you're going to go out for a business purpose for, you're seeing a potential client or whatever, hold on to the receipt. Just write on the receipt who you saw and what you discussed. Simple enough. You get a copy of your receipt, write it down. If you have a credit card statement, I've been in IRS audits where they'll accept a credit card statement, but it's up to the agent themselves. Technically, they have the right to disallow it. The best foolproof is receipts, and it doesn't have to be a lot of work. Well, I can tell my clients is you take your receipt, you put it in a shoebox, and you just stow it away somewhere. All your expenses, just throw it away. You can still calculate out the amounts using your credit card statements, your bookkeeping software, whatever you want. but stow away the receipts. Now, the reason why I like to say that is if you ever get audited, heaven forbid, I went to audits where I provided a shoebox full of receipts to the IRS agent, even though I had all the numbers calculated. The reason why is you could think of an IRS agency as a collections agency. They're not trying to get the most money out of you. They're trying to get the most money for their time. So the burden of proof, you have to provide expenses to say, here's my expenses, but I'm not going to make it easy for them. I'm not going to add it all up and give it to them in chronological order, even though I may have done so already. I'll give them that shoebox full of receipts because once they see that, they say, nope, my time is more valuable from this. Let's close the audit right now and call it today. You can look at it that way. So again, going forward, please do keep track of it. That's what I would recommend as well.
Thank you, Elliot. And thank you, everyone, for joining us today and for writing your questions and being so engaged. I know we have some questions that we just weren't able to cover. Unfortunately, our time is up. And, taxes is such a big topic, and it is super important when it comes to building your business. So if you want more information and you want access to the best tax experts, such as Elliot and the rest of the team at 1-800, you are more than welcome to claim our offer, get the tax filing services, and we'll be more than happy to help with anything else that is left unanswered or if anything else comes up. This offer will be available for 48 hours. And again, we're going to email it to you along with the recording of this webinar. So all of the information that Elliot presented will be available for you later on. Elliot, thank you so much. This was great.
Thank you for having me.
Have a great day, everyone. We'll see you next time.